Workforce Training Center. We're glad to have y'all here today. And speaking to us now will be Mr. Key Smith. He is an advisor at Natchez Wealth Management, where he assists clients in retirement and estate planning, portfolio management, and comprehensive financial planning. He graduated cum laude from the University of Mississippi with a bachelor's degree and magna cum laude from the University of Mississippi School of Law. After law school, he practiced securities defense with a large firm in Birmingham, Alabama, representing Fortune 500 broker-dealers and insurance companies. He is active in the Natchez community and is an active outdoorsman. I'll let you have the floor.
Well, thank you, Amanda. I appreciate all y'all's hard work getting this together. This is obviously a great event that's going to be a big benefit to everybody in the area. Like you said, my name's Key Smith from Natchez. This is our team at Natchez Wealth Management. We're an independent broker-dealer. We broker through a company called LPL Financial. LPL is out of San Diego, California. They're a publicly traded company. I think one of the big benefits that you can say about being independent is, unlike maybe what used to be a Morgan Keegan or a Merrill Lynch or Edward Jones, we don't have any proprietary products. LPL doesn't make any mutual funds. They don't manage any mutual funds. They don't manage any of their own portfolios. So we get to pick and choose from the best of the best. That gives us, like I said, more independence, more freedom of where to go and what to choose from. I'm going to pass some of these around. These are just some feedback forms. If anybody wants to fill one out and give your name and contact info in there, we can get back to you at some point in the future. Now again, my partner up there is Bill Byrne. He's on the right, looking very suave and sophisticated, and he's not. But he couldn't be here today because he had a 25th wedding anniversary. He told me if he ever wanted to come to work again, he should probably go on the trip that his wife had planned for him. So they took off. Thanks, sir. I've got a few more up here and some outside if anybody didn't get one.
I got an extra one if you need it.
I appreciate it. So Bill has been in the business for 20 years. He's originally from Natchez. He's with the Byrne Insurance Agency, was his grandfather. So he did commercial insurance for a little while, and then about 20 years got into financial planning and investment strategy. Julia Sandage is sitting outside of the desk we have set up. She's our office administrator, does a lot of the clerical work and helps out. And then Wendy Jenkins, the one on the bottom, is, like any office or any man, there's a good woman behind it that runs everything. She pretty much keeps us straight. She is also Series 7 licensed, so she's our executive administrator. Can enter trades when we're not in the office like today, and can take care of pretty much everything. And if she ever threatened to leave, I'm really not sure how we would get along. But we'd make it one way or the other. So what I'm going to talk about today, and I promise you, we're not going to be here an hour and 15 minutes. 35 to 40 minutes is probably going to be as long as we hold y'all to it. I don't have the voice to go an hour and 15 minutes. But I'm going to talk about, just kind of cover the topics of 5 smart investing strategies. We'll kind of go over just some general investing information and how we can help y'all out. We'll briefly cover state issues, what to do to prevent the federal government from taking your money in case somebody passes away. Just briefly, you have an estate tax limit of $5.34 million. So if somebody, let's say a widow passes away with a $10 million estate and has no planning set up, the federal government is right off the bat going to want a check for $2.2 million to cover your estate tax, which is a scary proposition. So when it comes to estate tax planning, $5.3 million is obviously a lot of money. But with this oil play and the way things are going, you're seeing mineral acres that could be worth, like Burnell said earlier, upwards of $10,000, $15,000, $20,000 an acre, depending on where you are, plus your surface acreage. You get into an issue that you could need to take steps to make sure your family keeps your money rather than the federal government taking 40% just because someone passes away. If I had it my way, we wouldn't have state tax, so I'm sure a lot of people think the same way because it doesn't make sense. You pay tax on everything you do your entire life, and then they're going to come in just because someone passes away and take 40%. It doesn't make a whole lot of sense, and it only accounts for 1.3% of the federal budget. So if they didn't have it, it wouldn't really change what goes on in Washington. So, and then I'm also, just to kind of finish up, my last thing will be, you know, in this situation with the amount of oil money that might be coming in, I'm just going to talk about, you know, things you want to ask any financial advisor you go see. Just kind of a hit list of, you know, what are the things you should look for, what kind of credentials that you try and make sure that your financial advisor or consultant has, and what to expect out of that relationship. Anybody have any questions off the bat? Peyton? Nothing? All right.
It's coming.
I know. I got a feeling that we could ask some strategic questions from you. So, and if anybody has any questions throughout the presentation, feel free to jump in. I don't want to be Professor Smith up here. But like Amanda said, I did undergrad. I have an undergrad degree in accounting from the University of Mississippi. I worked for a Big Four accounting firm, KPMG in Memphis, for a solid 8-month stint. I didn't enjoy it, and then went to law school. Then worked for a big securities defense firm in Birmingham. It was about 250 attorneys. We represented Morgan Keegan, Merrill Lynch, Charles Schwab, AIG, and ING were our main clients. And there's another area that I didn't necessarily enjoy that much. It was 12 hours a day, 6 days a week, and it was just a good thing to get out of. So I moved back here in 2009 to Natchez, took over a book of business. Bill Byrne came and joined in 2010. We manage approximately $200 million for families around the area. We have clients as far away as Alaska. We do anything from retirement planning for companies. We manage 401ks, SEPs, simple IRAs. We manage individual portfolios, rollover IRAs, college planning, insurance needs, and then try and help out with trust and other state issues, you know, when we are needed to do those things. So we'll start off with just a little video on how things on Wall Street work and events that may have influenced what goes on. Hopefully everything works smoothly. Okay, we'll skip the video. That didn't work out too well. But just to go over what we'll do right now, the 5 smart investing strategies that we're going to kind of skim over. 5 things. With 1, don't time the market. We'll look at some scenarios where trying to time the market and getting in and out has hurt the individual investor, being nervous about certain events. We'll talk about an asset allocation, where to spread your money around based on what your objectives are. We'll narrow down on what to actually invest in after we make the asset allocation. We'll talk about a strategy called dollar cost averaging. That's a good strategy to implement for everybody. And then the value of rebalancing your portfolio every once in a while to make sure you don't get out of whack with your investments. So, you know, the old adage that Warren Buffett always has is, when everybody else is fearful is when you should be greedy. When everybody else is greedy is when you should be fearful. You know, he said that forever, and I think we can all agree that at a net worth of roughly $60 billion, he's been okay at what he does. So this kind of goes back to that. You know, human emotion plays a lot when it comes to investing. You know, right now, for example, people are nervous. Clients right now are nervous about the frothy market. We've had good runs. People are scared that everything's, you know, getting too high. There's too much going on. You've got ISIS. You've got the federal government. You know, there's always going to be a negative. There's always going to be something out there that is bad news. So what we typically see from an individual investor, if you're a retail investor, is instead of the buying low and selling high, people end up buying high and selling low. Prime example right now, especially for this area, we look at our little oil companies around here, Halcon and Goodrich, 2 publicly traded companies that have been obviously on a lot of people's minds around here, and we've got people calling all the time wanting to buy some, and you know, people buy in because they hear things are going so well for them and don't look at the fundamentals of the investment. They just want to buy some stock. Well, both of those companies have dropped 50% over the last month. Halcon or Goodrich went from about 31. I think they closed yesterday at 16.50. Halcon hit as high as about 7.30 and got as low as 4.10. I believe that was yesterday or the day before last. So and we've seen other things around Natchez that have come through. There was a company that was going to drill the ultimate natural gas well down in Anna's Bottom, north of Natchez. They went from $5 to bankrupt in about 9 months. And you just see a lot of people get excited about things that are going on and jump in based on an emotional type move or because their neighbor says it's a good idea and don't really get into the underlying fundamentals of what you're purchasing, or does it even fit your financial strategy. So that's kind of just the human emotion side of trying not to time the market. And then this slide, I think, shows a good indication. Over the last 10 years, the S&P 500, which is the index of 500 of the largest companies in the U.S., has returned on average 9.22% per year. Now, you ask 9 out of 10 investors, and they're going to say, well, that's not right, because we remember the 2000 and the 08 period where we had such a big drop. But that's what it's returned if you stayed in the market every single day from that time period, 94 to the end of 2013. If you're trying to time the market and you missed out on the 5 best trading days, the 5 biggest days, your return goes from 9.22 to a 7% average return because of that compounding factor. If you missed the 10 best trading days, you're down to a 5.5% average return. And if you missed the 20 best trading days, you're down to a 3% return. So this just goes back to the emotion of people getting in and out of the market based on knee-jerk reactions and not really staying with, after we get done, talking about an asset allocation and rebalancing portfolios on a routine, normalized basis where you have a plan set up. Because it doesn't take much. I mean, you miss 10 days and lose out on 4% a year. On a $100,000 portfolio, that's $4,000 a year for 10 years. That's $40,000 less you would have right now because of those 10 days of not being in the market. So we'll tie the whole picture together once we get towards the end of the talk. But it's important to, if you're going to invest in equity markets, that you stay in equity markets and not have knee-jerk reactions. As this slide kind of indicates, 91.5% of returns are determined by asset allocation, not other factors. So having a good investment strategy and being in places that you need to be and that fit your objectives end up being more important than catching that hot stock for a short run. Because it's a lot more people pulled the Halcon and Goodrich and bought in at 25 and 6 and are now sitting at 16 and 450 than the other way around. Now, this is probably the most important part of the talk when we talk about what do you do with money when it comes to it. When you're sitting on a pile of cash and you're making, Tommy, correct me if I'm wrong, maybe 0.01% in a money market at the bank?
No, it's more than that.
0.02?
0.15.
0.15?
Some,
Okay.
CDs, you obviously pay a little more.
A little more. But if you're sitting in cash in a money market right now making 0.15%, with $1 million in cash, you'll make $1,500. That's just, you're not going to lose any money at all, but you're not going to make anything. So when you talk about, what is my asset allocation? Where do I want to put my money? These are the things, these are the areas we really need to harp on. So everybody needs cash. The Dave Ramsey approach, any financial consultant that has big national publicity will tell you, 3 to 4 months of cash on hand as an emergency fund is usually a good idea. I'm more conservative and say let's go 6 months. Let's keep 6 months of cash where if something happens to you, if you lose your job, if anything like that goes on, you've got money sitting there waiting for you to jump into in cash. You're not going to make anything. But the next portion you want to go, like Tommy said, you move up the risk spectrum of investments and you hit CDs. 1 year CD, 0.3? 0.35. I think, is it Copiah Community Bank might be able to go to 0.4. I think that's the best I've seen on a 1 year CD. But again, you're not making a whole lot of money on your CD investments. And it's, again, everybody's going to need cash. Everybody will need the cash equivalent with CDs. But there's a certain point for each individual with where you want to try and get your money to make more money for you. And not take on the amount of risk that you're comfortable with, that you think you can sleep with at night, and not worry about Halcon losing 50% over a 4-month period. But you move into other types of fixed income. Everybody's worried about taxes and what that means for oil money coming in and just for ordinary income. Well, a good alternative to look at is municipal bonds. Municipal bonds are debt issued by municipalities, cities, states, airport bonds, there's other types of bonds. All this is tax-free revenue. Right now, you can go out and buy a tax-free bond, and get 3 to 3.5% depending on the bond and the issuer, but all that money is tax-free. So on your $1 million portfolio, that's $35,000 a year, and the government doesn't take a dime of it. That's another piece of the pie for everybody's account for your asset allocation. Then you get into corporate debt, same type things as debt issued by corporations, your Walmarts, your GEs, whoever else it may be. And then of course we jump into the stock side of everything, the equity side of investments. And the equity side, just like the fixed income, not every stock is created equal. You have a risk spectrum that you have to worry about on your stock side. If you're a young guy like Peyton back there with tons of money, you can take a little risk. You can buy some small cap stocks that might have the upside of 10, 15% a year. But they also have a downside risk. There's much more risk to it. As you figure out what your risk tolerance is, you look at different areas of the market. Go into utilities and telecoms, AT&T, Southern Company. Get into companies like that. They pay 4 and 5% dividends to their investors. So if the stock, if you buy AT&T and it stays flat for 2 years, you're still going to get a 5.5% dividend that's paid out to the investor. And that dividend comes at a better tax rate. It's not ordinary income. You only have to pay a 20% tax rate on that money. So there's options in the stock market that aren't exactly, they're risky. They have up and down, but they're not the risky of the risky. You can get in some stocks that are more stable. Now, one area that we do want to talk about is that speculative side. And that includes what they call alternative investments. Alternative investments have been a growing field here lately, and have been a good income stream for a lot of investors. An area that we think very highly of right now is oil and gas transportation companies. These are the companies that are moving the oil and gas from the field to the refinery. And they'll move it via barge, rail, pipeline, truck, any way they can move it, they'll move it. They own the physical assets that move the oil and gas. And what they end up doing is they pay a huge dividend to investors. And you can get about a 6% dividend out of these oil and gas pipeline companies. They work like equities. They move up and down with the stock market. They trade daily, but they're considered an alternative because of their tax structure. They're considered master limited partnerships. So if you buy one of these pipelines, say somebody like Genesis, who has an office in Natchez, you can buy Genesis or Plains All-American. As an investor, you'll get a K-1 at the end of the year rather than just a 1099 because you're a partner in the corporation when you buy in. But you're going to get a 4 or 5, and some of the companies go as high as an 8% dividend off of these companies. So it's a great cash flow, great spin-off. Another type of alternative investment is called a real estate investment trust. You've got a lot of people that love to buy real estate and love to do rental property because of the cash flow. Because you can buy a home, turn around and rent it for $500 to $1,000 a month, whatever it may be. Well, there's companies that you can invest in without dealing with the headache of tenants, without somebody calling you at 10 o'clock at night and saying, hey, my pipes just burst. There's companies that buy real estate all across the country, and they'll have residential real estate investment trusts, which would be apartment complexes and housing units. They have office complexes, warehouses, strip malls, hospitals. Hospitals have been a big interest of REIT investments here recently. And just like the master limited partnership, they end up, because of their tax structure, paying out a very, very nice dividend and cash flow to the investor. So you can look at somewhere around 5-6% cash flow from these real estate investment trusts. Now there's two things you really need to look at when you're looking at any alternative investment that has this type of cash flow. You need to see if what you're getting into is publicly traded or privately traded. A lot of these companies, if it's a publicly traded REIT, you can buy and sell it every day of the week, or 5 days a week on the stock exchange. If you feel like getting out of it, if you need money for something, you're out. Privately held REITs and privately held alternative investments, private placements, put restrictions on what you can do with your money. You know, what they're gonna offer is more cash flow. They might pay up to 8% in dividends. But if you had, let's say, $50,000 invested in a private REIT, and you called me and said, hey, I need $40,000 now to pay a tax bill that you didn't know was coming. There is a chance that the private REIT closes off redemptions and you can't get out of it, or you have to stay in for a certain amount of time. So one of our big things is we don't buy private REITs. We don't buy private placements, because what's the point in having money if you can't turn around and use it when you need it? You know, if you need to get your hands on your money, you need to get your hands on your money. So that's one thing, you know, to really look out for with whatever financial advisor you talk to. You want to make sure that what you're getting into is liquid, that you can get out of it if you need to. Now, you know, depending on each person's individual, I mean, if you've got, you know, a bunch of money, a bunch of cash sitting around, well, a portion of it might be okay for something that's privately held. You know, we don't put much in it or any in it at all, but you know, a small portion, something that you know, okay, I've got $500,000, I can put $25,000 in here and be willing to get that 8% on that money and not have to take it out. But that's a big thing with alternatives. All alternatives come with different restrictions on what you can do with your money. Now, the privately held REITs, you know, and alternative investments, and even pipeline companies and debt structures. Another advantage, or what you'd call an advantage, they don't fluctuate with the stock market. So if you buy a REIT and you buy $50,000 of it, your value, every time you get a statement, will stay at $50,000. So unlike a stock market portfolio that may go up or down with the market, you're going to feel better when you open up and say, hey, we're still at 50. You know, we hadn't lost it. So, and they're going to pay you out a little more in dividend, but it might take a while before you can actually cash out or redeem those securities. So that's just something to keep in mind if anybody starts talking to you about alternative investments and real estate investment trust. When it comes down to, you know, your actual investment selection, you know, that's going to vary for every single person. You know, it depends on the amount of assets you have, the amount of risk you're willing to take, what type of what your goals are. You know, there's no perfect investment that I can tell everybody in this room to go buy, because what Ms. Bonnie may need is completely different from what Mr. Tommy may want. You know, we're goal-based investors. You know, we want to sit down with you at the table and say, okay, here's the money coming in. What do you want out of it? Do you want it to double? Do you want to try and increase your portfolio as much as you possibly can, or are you perfectly happy just getting 4 or 5% returns, you know, just to get more than what you can get out of CDs? You know, there's no, I can't say this is the best investment, jump in it now for everybody, because for everybody it doesn't work. You know, there's some things that some people just don't need to be in. So it's all a matter of when you sit down with an advisor or with anybody that you're talking about money, that you reach a goal. You find out, you say, hey, here's what I want my money to do for me. Because as we just talked about with asset allocation, there's different strategies to get there. You know, so it's there's no one size fits all when it comes to investing your money. So again, here's just a slide looking at long-term performance based on kind of the three major different asset classes. 20 years ago, if you put $10,000 into the bank, you know, you'd have $17,785 right now had you just left it sitting in cash. Of course, 6 years ago, what was money market paying? 3-4%. You know, now we're down to the 0.15. So the last since 2008, money markets have been next to nothing. But you still end up with that amount. Bonds, and you can see it's a nice smooth line. There's no down in that. Bond funds, $38,069, which again, that's, you know, tripled your investment, and you know, mainly just on an upward swing. And then of course you see stocks on the top where $56,422. You obviously had much more return out of your money, but you can look at the periods from '98 to 2002, and there were a lot of people not sleeping good at night at that time period. If you're in bonds or cash, you're still sleeping and waking up in the morning, you're fine. You know, so that's where it comes down to what percentage of your assets go into each asset class. And again, of course, the 2008 period where we had a sharp, quick 35% drop in the Dow Jones average. So overall, we've moved up at a pretty nice pace. But, you know, there were some periods in there, and there will be periods in the future where stocks are going to have, you know, significant drops. It's happened forever. It's going to continue to happen forever. There will be times of corrections. This kind of breaks down year by year over the last 10 years, you know, where your best performance has been. And you can see what I was talking about. 09 to 13, cash in the bank, zilch. You know, 0.16 to 0.05%. That's not a whole lot of interest earned. Bonds have been a little bit better. Bonds do have down years, because bonds have two types of risk to them. If you buy a bond from Walmart, let's say, you run two risks. If Walmart goes under, they stop making payments and you lose your money. So if a company declares bankruptcy, that bond will default, and that's a risk you run. That's called credit risk. The other risk is interest rate risk. As interest rates go up, bonds go down in value. So if you're holding an individual bond, let's say you put $50,000 in a Walmart bond at 4%, and you did that yesterday. If rates start going up, when you get a statement on your bond, the value of that bond is going to go down as these rates go up. Because if Walmart issues more debt a year from now, and rates have gone up, I could take $50,000 and buy a Walmart bond at 5%. So why would I pay you $50,000 for your 4% bond when I can pay $50,000 for a 5% bond? So that is an issue we face right now with bonds, because rates have been historically low as they've ever been. The federal government is still saying they're going to continue to keep rates low for the foreseeable future. We don't know when they'll start going up, but we feel like they have to start going up. You can only stay at the bottom for so long before they start trickling northward. There are some strategies you can take to offset that. They have bond funds that are considered loans. Kind of like if you go to the bank and you get a fixed rate mortgage, you're going to pay 4% for 30 years. If you go to the bank and get an adjustable rate mortgage, your rate will move up or down depending on what rates do. And we can buy the same type of fixed income products to insulate that risk. But there is a risk with bonds. But as you can see from the stock market returns in 08, with that 37% down year, bonds have not had a 37% down year. But the stocks did outperform. What's that? To seven out of the 10 years, they've been the best place, you know, for your money. An investment strategy that a lot of people implement is called dollar cost averaging, and this works well with retirement plans. If you're funding money into a 401k at work or to an IRA account and you're doing it on a systematic basis, every month you're buying $400 worth of, let's say, a mutual fund, but on the months where the market goes up, you're buying less shares. When the market goes down, you're buying more shares. So at the end of the day, you end up getting a better cost per share than the average price per share while investing the same amount of money. And this would be a strategy to implement, you know, if oil royalty starts rolling in for some people, and you know, hey, we're getting $10,000 a month, we want to invest $3,000 of it. You systematically do that on an automatic basis based on an allocation you choose that fits your needs. That way you're buying in every month, same time, and getting a better bang for your buck. And that shows buying in a falling price. This slide shows a rising price. Same scenario, you continue to buy less shares on the way up. And again, this is kind of what we've been harping on the whole time. You know, depending on your investment strategy, your investment goals, or what you need, everybody needs a different balance of where your money goes. You know, this shows over the last, this was the last 10 years. Had your money been invested, the last 10 years, you had this allocation, 60% cash, 20% bonds, and 20% stocks, which would be that's a conservative allocation. You're not taking on a whole lot of risk. At the end of 10 years, $295,694 based on index returns, average return of 5.6% a year. You know, you've really decreased your risk, but it all depends on, you know, where you want to be. This is more than likely a retiree type portfolio, somebody that knows they might be needing to use their investable assets soon, whereas this account is a younger individual who has got a longer time horizon before they're gonna need to use the money they're acquiring. So an 80% stock, 10% bond, 10% cash account, you end up with a $507,000 balance, 8.5% return a year. And you can see that worst year at 32.7 was much worse than the negative 12.4 that you would have gotten in the more conservative balance. So, picking where your assets go, how we allocate, all depends on where you are in the life cycle and what you want out of your money. If you've got a chunk of money and you say, look, I don't want to touch this, I'm 40 years old, when I'm 60, I want to start trying to use this money in retirement, well, we're going to be in something a little more similar to this. Maybe not quite that aggressive. If you're on the flip side, if you're 65 and you've gotten a lease bonus check or got oil money coming in, we're probably going to stay more somewhere around this as a recommended allocation. But if you've got oil money coming in, you say, look, I just want this portion to grow as much as possible. We can do what each person's individual needs are. But in a typical situation, if we have someone that has a time horizon of say 18 years plus, we're gonna lean heavier into stocks because historically they return more money than bonds and cash. The rebalancing idea. This is I think we're our second to last of the 5 points, or the last of the 5 points. If we reach an allocation and say we're going to go 60% stocks and 40% in fixed income and bonds, and also we got a banner year in the market runs up 30% like it did last year, well, all of a sudden you're going to be 65 to 68% stocks. Well, what we want to do on a quarterly or semi-annual basis is rebalance your account so that you keep that allocation where we want it. Because if you ignore your account and let it run up, and let's say we have, well, like the last 5 years in the stock market has been very good. So if you came to us 5 years ago and said, I want to invest this money, and we went 60-40 and we ignored it, and we didn't touch the account, you'd now be at like 80-20, okay? You've made a lot of money, but if the market drops 20%, you stand to lose a lot more, and you're taking on a lot more risk than you had originally. So, what we do is come in and we're going to meet with you on a quarterly basis and say, all right, we're tweaking the account to keep you in line with where you need to be. We'll talk about what's going on with your life. Has there been any kind of significant changes? Do you have children or grandchildren that you want to do just set up college plans for? We'll look at life events that happen with you, tweak your account, and also make sure we're keeping your allocation where it needs to be so you don't end up getting caught in a 2008 situation where the market drops 30% and you're looking at me saying, I thought we were, at a 50-50 balance. I thought we were fairly, a little moderate, not so much aggressive. Well, we want to make sure and ensure that we don't get caught in those kind of situations. Obviously, we can't guarantee up all the time. There's going to be downturns in the market, but we want to do our job to make sure you're keeping an allocation that fits your needs, meets your objectives, and keeps you happy at night and sleeping well at night. Because the last thing we want to do is be fretting over, hey, am I about to lose all my money? We want to have you set up where I know this much will be coming in, I know I'm taking on this much amount of risk, open communication between everybody to keep us all on the same page. So this is just a kind of a homework assignment would be, with your investable assets, with retirement accounts, with cash sitting around, and your liquid assets, kind of go home and look at, hey, where do we stand? Do I have 100% in cash? Is it time to say, okay, well, I need to start doing a little bit with this cash. I'm not ready to take on stock market risk, but do we move up the ladder and go out and buy some municipal bonds and get 3.5% tax free? That's just a little homework assignment. That's what I'm talking about with the investment, just kind of skimming over that. Does anybody have any particular questions about anything on the No? All right, the next thing, which is probably might be a little more pertinent, talking about estate matters. What do you need to do to ensure, like we talked about, that the federal government doesn't walk away with 40% of your estate if you reach that situation? There's some basic things we need to do, things we need to kind of consider, documents we need to have in place that will help you, along the way when that does happen. So, managing an estate is twofold. We do the things we just talked about with managing your estate and your assets while you're living, while we're creating an asset allocation, and while we're investing your money as you deem fit. And the estate part kicks in after your death. You know, where do we need to go from this matter? And at LPL, our back office has got a very, very good and very highly educated team that deals with nothing but estates. We've got about a 40-person team that is, they're attorneys, accountants, CPAs, and certified financial planners that can look at everything you've got going on. We can evaluate your mineral values, your surface values. We can look at your insurance that you possibly have and turn around and say, okay, given everything you've done, you're off to a good start, but we can also do this to add to what you're doing to protect your estate. There's basic things to do, like having a will and possibly having a trust and gifting assets. But there's other more advanced strategies that come in that I'm not gonna lie, it's a little bit over my head, but that's why we have that team back there that will set up what they call grantor retained annuity trust, where people can move money for a certain time period out of their estate. You know, there are definitely ways to keep the federal government from taking your money, and it's just a matter of knowing who to talk to and knowing who to think about when these things come up. So this goes. This is the slide that we don't get to watch because of whatever reason. George Steinbrenner, the estate tax has changed throughout the history. It used to be states were as low as $1 million. Anything over $1 million estate was taxed at 35%. They excluded estate tax for, Peyton, what year?
2010.
2010. George Steinbrenner died in 2010 with a net worth of approximately $15 billion, and his estate paid zero because the government shut down estate tax for that 1 year. They have since reinstated estate tax, and now, like I said earlier, it's $5.34 million that you can exclude out of your estate. Anything above that number is taxed at 40%. So the question is, if we have an issue or have a potential issue, because the big thing right now is we don't know where this oil play is going to end up. We don't know how big it's going to be. If you've got 100 acres of minerals in a unit, and they go full throttle and end up putting the 5 or 6 units or 5 or 6 wells per unit, you could very well end up with estate tax issues. You know, I mean, with the amount of money they're talking about generating, 1,000 barrels a day, 5, 6 wells, even when they drop off, you're talking about substantial money per day with 50 to 100 mineral acres. So even if you don't have an estate issue right now, it's not a bad idea if you own minerals to start looking into what might I need to do. What can I do to make sure that in 3 years if I die in a car wreck and this thing's going full boom and you haven't done anything, your family will be stuck in a situation where they're selling land to pay estate tax. And of course nobody wants that. I mean, there's been plenty of cases around this area, and I know especially in Natchez, where patriarch of the family or matriarch of the family passes away unexpectedly. No estate tax planning has been done. They've got roughly 10,000 acres of land. All of a sudden, they're selling off 3,000 acres to pay the estate tax because they're what they call what you call land poor. They've got a lot of net worth, but it's all in dirt and trees. So they didn't have the cash to come up with a $1.5, $2 million tax bill. So they're stuck turning around and selling 3,000 acres of the family farm. And that's a real situation people could be in around here, when your mineral acres could be worth up to, like we said, $5,000 an acre. Surface land goes for, Renee, what do we want, $2,500 an acre, $3,000 an acre?
Surface? Oh, I like that.
Five, well, Renee's going 5. So you're talking about $10,000 an acre right there. It doesn't, you get 500 acres of land with minerals under it, you're at $5 million right there in your state. So it's one of those things where we can start looking at what's going on now, what could be down the road, what can you do to give some of those assets away, but still maintain control of the assets, not give away the farm, so to speak, to deadbeat kids. Everybody loves that one. So the first thing to look at, there's not really a slide on this, and this is I have to caveat this with consult with an attorney before you take my word for it, because I went to law school and practiced law, but I'm not a practicing attorney, so I can't give legal advice. But you can put assets into a family limited partnership or any kind of limited partnership. By doing that, that reduces the value let's go with the $5,000 an acre surface, $5,000 an acre mineral, $10,000 per acre total, 500 acres, $5 million. If you put all that into a limited partnership, you reduce the value of that land by anywhere, depending on the appraisal, from 20 to 30%. So right off the bat, just by putting land to a family limited partnership, not giving anything away, you've gone from $5 million to roughly $3.5 to $4 million. So right there, that's $1 million window, $1.5 million window you saved yourself. So that's one step you can take that's easy to do, to talk with an attorney about getting that set up, where you keep everything in the family, in control, and you've got it passed out of your estate. So that's an easy thing to do. You do have to deal with attorneys. Nobody likes dealing with attorneys, but they come in handy when you need them. Everybody hates them until then. Question? You an attorney? If you're an attorney, I'm sorry. I didn't mean anything
My
about it.
attorney's good.
But that's,
What about a living trust?
we're coming there.
Is that the same, similar to this, family?
No, ma'am, that's a different type vehicle to use. So, we'll jump into it with the living trust. Well, we'll go slide by slide. So how state taxes work, we got to that. This is a little history on the state tax law we already went through. There's an example, and that the state tax number rate is wrong, it's now 40%. So $7.5 million estate, 5.34 million exempt from your estate. Taxable amount 2.16. It's actually a 40% rate, which bumps you up more towards $900,000 that you would owe in estate tax as soon as an estate tax return can be filed. And you can see Peyton Captain about filing all estate tax returns. Nobody wants to go through that. There are steps you can take to get through that. One, that family limited partnership or any kind of limited partnership is a good measure to go through. There's some basic documents that we kind of talked to before we really get to the bulk of estate tax. I mean, everybody needs to have a will drawn up. A will that just helps dictate where your assets go when you pass away. Wills have pros and cons. They dictate where everything goes. At the same time, though, they can be contested. So let's say you have a family of 4 and somebody feels like they got jaded in the will. They can turn around and contest the will and take it to court and hold up everything as people try to figure out what's going on. And no matter how much everybody loves their family, when it comes to money, families can get a little bit crazy. I have personal experience with that. And we didn't even have any money. So it's you just never know what's going to happen there. But a will is a good thing to have. Again, any attorney can draw up a basic will to dictate where your assets will go. A will has to go through what they call probate. So when you file a will, when somebody passes away, you file a will. Creditors have 60 to 90 days to file claims against the estate before anybody gets assets distributed out of that estate via the will. So those are just issues with the will. A will is also, probate is also a matter of public record. So if you have a sizable estate and you leave it to your family in your will, any Jane, Harry, or Joe can go to the courthouse, look through the probate and the public record, and find out what was passed on, who's getting what. Right? So that's something you want to consider. It's a benefit of having a trust over a will, because trusts aren't probated; they're more secretive in nature, and they're typically not contested because they're done up as the person is living. The trustee signs off, and it's over, and the trustee has to abide by what the trust says. Much less likely to get contested by a jaded family member. So just other financial documents you want to have. A living will dictates, what goes on with your health care. When you become independent, you're giving someone else control of, hey, pull the plug, this happens. That's something that needs to be in place. Power of attorney kicks in, and that can be for anybody. We deal with a lot of them. For example, with our clients that are offshore workers, especially guys that go international, typically have a power of attorney. So you're giving someone else the right to handle your affairs if you're not around or incapacitated or out of country. We see that a good bit. And the durable power of attorney is when you're giving someone total control of your health care. When you say, okay, you make the call for me. Very similar to a living will. The thing about health care right now, the 30% of seniors don't have any kind of documents put in place. 72% of home health care patients and nursing home patients don't have any kind of living will or durable power of attorney in place. So this is a good thing to consider for loved ones. It's hard to talk about because you're talking about demise and getting very sick, but it saves a lot of headache down the road, both with the will for the financial matters and for the healthcare side of things. Now, there's different financial documents that will help with spreading the estate around. You've got joint ownership, just puts things in common name. That's a fairly common thing. The durable power of attorney, that, like I said, gives someone the right to handle financial affairs. And then we get to the living trust, which a living trust enables you to pass assets to your beneficiaries or to whoever you deem a beneficiary of the trust without going through the probate. So it's getting money out of your estate, putting it into a trust, and then when the trust kicks in, upon death of someone, or upon funding of the trust is set. That's it. You can set up trust any way you want to. We have trusts set up where family members cannot spend any of the principal amount until they're 30, 35 years old and only get income distributions out of the trust. So going back to the pipelines, we have a lot of pipelines for those trust accounts because they make 6.5%, but they're set where they can only take the income off these trusts. You can set up, when you're setting up trust, you can sit down with your attorney and make it any way you want to. You can put any kind of restrictions on it, any kind of income limitations, any kind of age determinations. The one thing about most trusts is that they do have to have a time duration. They can't be perpetual in nature. Tennessee has the most flexible state laws on that. You can set up a Tennessee trust. You do not have to be a Tennessee resident at all. Their trust lasts for 150 years. That's the longest in the country right now. Most everyone else is 99. There's talk of doing away with the rule of perpetuity, which is what sets these threshold limits. But as of right now, Tennessee has the longest trust provisions at 150 years. So that's many generations.
You're saying that if I wanted to put up a trust, I could go to Tennessee and have a trust set up and it'd be honored everywhere?
That's right. What you have to have is a Tennessee trustee or a Tennessee
Resident.
No, you do not have to be the resident of Tennessee.
No.
You have to have a Tennessee entity that has control, that serves as trustee. So ours, we've done a lot through Trustmark Bank. They serve as trustee. They have a Tennessee domicile. They have a Tennessee office. They can serve as trustee or even co-trustee. You just have to have one of them. But that's the longest that I know of that you can do in the country. 150 years, and that's the state of Tennessee. 150 years, but we're probably not going to see the end of that one.
You mentioned the bank being a trustee. Do you feel like that's the best way for people to go?
No, we've had to do it because we had to have a Tennessee.
I mean, overall, not necessarily Tennessee, just.
No, I tend to lean towards if you can get your accountant or your attorney to serve as trustee. I think that's a better approach because they're more involved with all the affairs. The problem is it's becoming more and more difficult to find someone that will serve as trustee because of the liability that comes with it. There's certain, as trustee, there's certain requirements that are put on you to invest money as a prudent investor, and anybody can file a claim against the trustee, and any beneficiary saying you mismanaged our assets. So if you're talking about big trust, $5-10 million trust, it's a lot of liability hanging on somebody's head. So it's hard to find local individuals usually to step up. Now I don't think having a family member is the best route to go because that can just cause issues. It's nice to have an outside third party that can serve as that. I mean, I'll ask Peyton or Tommy or Ms. President, if they have, do y'all serve as trustee at the bank? Do you have any of those capacities?
We do not. Most of ours, the trustee is usually another corporation, like normally banks.
Yeah.
Yeah.
Yeah, I know with most of these big trust companies, they're gonna charge an annual fee, and typically, they don't have to do very much, and they charge a pretty hefty fee to handle a trust. So if you can find someone willing to step into that capacity as trustee, that's not gonna charge you anything, because usually you have to file a tax return every year for a trust. But other than that, if the trust is set up where it just resolves upon somebody's death, there's only one event, there's only one distribution. So a lot of times these trustees get paid and don't necessarily, like I said, don't justify their pay for me. But I would lean towards finding CPA, attorney, good family friend that would step into the role of trustee and serve in that capacity. But it's hard to find somebody to step into that capacity.
Do you see any benefits of having co-trustees, say like the person you're talking about in the bank?
Yes, because you've got two involved. You don't have to go through the problem of finding a successor trustee if someone were to pass away. Now most of ours that have gone through Tennessee, actually the patriarch of the family actually serves as co-trustee, and the bank is he makes all the decisions, and the bank's just on the bottom in case something happens to him, they step into that role. But that was
The
their
bank
personal
still gets
decision.
their fee.
The bank still gets their fee. Bank still gets their
No matter
fee. Yeah, and they charge for the estate tax return, they charge for, there's a lot of fees that are associated with doing a trust if you can't find somebody to step in as trustee. Typically you see 50 bips, 0.5% is what they charge on the trust. So if you've got a $10 million trust, they're charging you, what's that? 1% of 10 million would be $150,000
Per year.
per year. And there may not be a single thing they do throughout that year. But different trusts are set up differently. If you have trusts set up that do income distributions and send out a certain amount per year, they keep up with all that, and they earn their keep. But there's some trusts that you can find, if you have a trust set up that dissolves upon someone's death, then having someone that would just step into that role, an accountant, an attorney, a good family friend that you trust, that's not going to charge you, but may charge you upon dissolution, charging an hourly rate that you agree on the front end. That's a better route to go, I believe. Again, that's personal opinion. That would be something you sit down and talk to your attorney about. And if you want to set up a Tennessee trust, you move to Mississippi, sometimes you're stuck having to get a Tennessee trustee of some capacity because you have to have that. But that is where it is. So, talking about trust, going back to the 5.34 million $5.34 million estate tax, you can also give away that much money in your lifetime. Okay, so that's how these trusts work. If you've got $10 million and you move some of that money into the trust, that offsets your estate tax exemption. So what we see a lot of people do is you move mineral acres into a trust, preferably before a lot of this has taken off or before your acreage has been drilled, because you can move those acres in at a lower appraised value. Let's say if you've got acreage in the area that is not in a unit, you might still be able to get a $500 to $2,000 appraisal on those acreage. If you move them into a trust at this point, and then all of a sudden a unit comes in, you're looking more at $4,000 to $5,000 an acre. But it doesn't matter because you've already moved that out of your estate. You want to move assets into a trust that have a lot of income potential or growth potential. Moving your house into a trust, your house is what it is. It's probably not going to gain that much value unless the oil boom hits. Then your house may increase drastically in value, but typically a house is going to be the least appreciating of your assets. Now, going on to that, the gift tax, kind of one of the last things we'll flip through, is each person can give away $14,000 per year per recipient. So I could turn around if I was if I had a $7-8 million estate and I had 3 children and they're all married, I could give each child $14,000 plus their spouse $14,000. So that's $28,000 per couple. Now, if you give them $16,000, the recipient has to turn around and pay tax on that. Peyton, what are we talking about 40% on the?
Yeah, the top gift in the state tax rate is 40%, and there are some lower brackets, but typically it's, you typically see a 40% bracket.
So that's another way to help get money out of your state, just by giving it away. Give it away to your loved ones as you're living. And like I said, it's $14,000 per recipient. So, every recipient will be very happy about this.
And a married couple can do a split gift too and step that up to 28,000, just wanted to add
Right.
that in.
Yeah, husband can do 14,
Yeah,
wife can do
exactly.
14, 28 to each child, spouse, whoever you want to give. Is there limitations at family only? Or you can give
No, it's not, you can give a split gift to anybody.
So you can give away a lot of money if you need to.
So that's 14,000,
Friends?
Per donor or
okay,
per
the
donee.
recipient, do they have to pay any tax on it?
The
at
recipient,
14,000?
the recipient's never liable for gift tax. It would be, the donor is responsible for the gift tax. So you're gonna give the gift and also pay the tax if you were in a taxable
And what's
situation.
the tax?
It mirrors, on 14,000 it'd be zero. That's like a standard deduction. So you wouldn't have to pay any, you don't have to file a return as long as you're under that amount. When you get over that amount, you have to file a return, but you start dipping into your unified credit, which is the 5.3 million that he was talking about.
And what is the
Once
lifetime?
that is used up, then you'll have to pay tax on any overage.
What's the lifetime gift amount that one person can give over their lifetime?
5,340,000 of taxable gifts. That does not include the 14 annual.
But if I have 10 people, family, friends, that I wanna give $14,000, each one of them, you can do that and not have to pay anything on it.
That's exactly
And
right.
they don't have to pay tax.
That's exactly right.
Okay. How would you, you would write them out, each out a check, right?
Yeah, that's right.
No- And you write on the check, gift, right? And you don't
Yep.
have to,
That's right.
oh, okay.
If you got your checkbook, you start writing checks.
Hey, give it back to me.
Well, and that's,
Not hide it.
there are families that have that structure where they give away your gift as much as you can, and they turn around and pay bills or do whatever they can just to get that money out of their estate,
And that's 5.5 million per person or total?
per person.
No,
What?
that is your lifetime exclusion. That's an annually
The total is
adjusted amount.
5.5.
That's what you have for your lifetime. That's adjusted by inflation every
5.4
year.
million.
5.34.
5.34 million.
And your spouse can give away that much.
Is exactly right.
Right, so a couple can give away $10 million.
What stops you from letting your children money to go to school, say $200,000 to go to school, to medical school or something, and if the loan never paid back, I mean, so where's the taxes that go with that?
Well, that one year, you'd be paying, of course, if you structured it as a loan and then just forgave the
The
loan,
loan was away.
somebody you'd end up in, who'd be taxing that payment?
I'm really not understanding the situation that he's saying.
If I decided to go to medical school, I take $200,000 from the medical school,
Yeah.
and in effect, either I die or the loan's forgiven, whoever finds out about that?
That loan would be part of your estate. That's receivable to you. So it
The
would
loan's
be,
never recorded in place.
it's still receivable from tax code, so.
But you could forgive 14,000 per year.
Right, I know, I'm just saying,
That's
there's no,
exactly
child,
right.
you don't have any,
Yeah.
there's no record of it, basically.
Well, there'd have to be a gift tax filing at that point to get $200,000 in 1 year, right? I mean, or
Exactly, yeah.
upon forgiveness of the loan.
Well, he's talking about a loan, a loan situation, no, you wouldn't have to file a gift tax return.
Bankers?
No problem with that.
No, they wouldn't be liable for a gift tax return, but liable to pay it back. If it goes through the estate, though, it's going to be brought in as part of the taxable estate, or part of the estate. You may not have a taxable estate, but it'd be included as an estate asset.
But why would you bring it on the state?
That's the law.
Oh, I see. What am I being called?
And look, that wall screws everything up. It really just gets in the way. So, I'm glad Peyton came and sat in, because there's definitely some that I need some help on.
You can do the same thing with land.
Right, right. $14,000 in value of anything, land, mineral rights, if you own timber value anywhere, you know. So here, like we already talked about, the benefits of the trust, you know, you can still control pretty much what goes on, effective management distribution, no public record, and like I said, difficult to contest, so that's always, always on the deal.
I've got one question about the land. If you donate 20 years ago, an acre of land in Mid-County was worth $800. Today it's $4,000. If for the past 20 years you've been donating the same 14 acres per year, based on it being $1,000,
Well,
how far back can they go or whatever? Say, well, now you donate land that's $5,000.
you have to use the fair market value, an appraised type value, or neighboring property, to get the value.
But at what time will they check that? Because if it's not checked,
Right, that'd be upon death. If you had estate issues, they'll start trying to call back provisions go 7 years.
okay.
Peyton, correct me if I'm wrong, if you, let's say you sell one of your children 100 acres,
Okay.
and you establish the rate, the value right now, $4,000 an acre, then you can then forgive, you're like financing it for them, you can then forgive the notes at a rate of $14,000 per year, and you've stopped
Yeah.
that escalation of the value of the property.
That's exactly right. That's just an easy way to give 14,000 a year is what you're saying. You're just writing off the note. You're forgiving the note almost on an installment basis to give your $14,000 to them a year. It's just another way of giving them a gift. And that's just a way to use that minimal deduction.
And then
So-
you don't have to worry about the value of the property going up.
That's correct. Now, any unforgiving loan at your date of death would be potentially part of your estate if you had a taxable estate.
But you don't.
Well, let me answer it was suggested to my, accountant attorney to go on, I went on and gave a part of my mental rights to my children already, so they'll get a mental check. Is that the same, is that different from this kind of gift?
No, if you gifted it to your kids,
Already, yeah, I
Already.
gave it to them,
okay,
where they'll get a check. Alright, so, I won't have to pay taxes on that, right? That I gave them this.
no, that's their responsibility.
Now,
The income that comes
Well,
in,
that's right.
she's very likely liable, though, to file a gift tax return. It's probably gonna dip into her unified credit, the 5.3 million. So, did y'all have any valuations done on the minerals or anything? Get the minerals valued?
No.
No. Yeah. Yeah, so that's what should have been done, and you can still go back and do it retroactively, and then you need to file a gift tax return. It may not be, you may not have a taxable gift, but if the value of the gift was given to more than $14,000 per donee, then you're liable to file a gift tax return, and it's going to use up that 5.3 million at lifetime
Okay, so
exemption. you know.
my accountant needs to do that then.
That's correct.
Okay.
And you'll have to get someone to value those minerals, to give you an appraisal on the minerals.
Correct me if I'm wrong.
I gave it to them before.
Same deal, as long, if you give them the minerals now, before you lease your property, then you can have your
Yeah.
valuation at almost nothing.
right,
Because there's not been a value established because you leased your minerals. Once you lease your minerals,
That's right.
then they use that to help determine the value. So if you give it to them before.
That is correct. Now, I was talking to Key about this earlier. The most recent valuation I've seen on non-leased, non-producing minerals in Wilkinson County was about $500 an acre. Now, once that is leased, it's gonna go up substantially over that, and if it's in a proposed unit or it's in production, you're looking at many times that, the value. So, it just depends on the state of the minerals and what the value is gonna be.
yeah, the earlier the better. And ma'am, of course, when you give your minerals away, your children can still gift you $14,000 a year. When you give your minerals away, your children can still gift money to you every year from that royalty income.
Well, would it be better then to instead of giving mineral store, mineral license store, would it be better to have the limited, family limited partnership?
Give it to them. If you put the minerals in a family limited partnership, that's gonna reduce the value just because the ownership is gone and control is gone. And then if you try and give part of the interest of the partnership, you get even a more reduced value. So yes, your approach move it to a family limited partnership. Let's say let's just say $5 million worth of minerals. Family limited partnership drops it down to $3.5 million in value because of the appraisal you'll get in a partnership versus sole ownership. Then you start gifting away the percentages of the partnership.
Now, this land is unequally divided between my sister and I. And I just gave them my part, I just say I could have it.
Well,
And I gave them
give
10%
your sisters
each.
too. They probably-
But she gets it all. I mean, her 50%, and I
Right.
just get 30%.
Cause you gifted away 20% of it.
Yeah, give them each 10%. Couldn't that be a partnership, my kids and me? I mean,
At this point, if you gifted that much away, you might want to put your remaining 30% interest into a family limited partnership, because that would decrease your value by 30%. So that would be, and that's, again, this is an attorney question, but that would be the strategy I would think about looking into, putting your remaining 30% into a limited partnership. That way, family limited or just limited partnership.
If you put it into a family limited partnership and gift to your kids, or in some cases, young grandkids, you maintain control like you do a family trust?
If you maintain, there's issues with that. If you maintain a majority interest, then all bets are off. You know, you want to gift away, you want to keep a 1 or 2% stake. You want to be a minority holder in there. And then there's also issues if you contain the general partner status and keep control of everything, then you lose the benefits too. So you really want to give away, and this is all done kind of, you still control it, but on paper you don't, if that makes sense. So yeah, you want to have a minority interest and you don't want to be the general partner. You know, name your wife, general partner, name.
You want to make sure too, you wouldn't have a taxable estate otherwise too,
Right.
I mean, like Renee was saying, gift them early, that's getting the appreciation on the assets outside. But if you would have not had a taxable estate with the appreciated assets, there's no point in making the gifts, because your children or heirs or whoever they may be will get a step up in basis for income tax purposes if it passes through an estate. So I mean, there's no cookie cutter method to all of this. It's all on a very individual basis.
And see, we're right now in a unit, we're in a unit with a well being drilled, but not yet producing. So the question is, okay, do we try to do this quickly before it starts producing? That's not those kid, I'm not actually the landowner, I own this much.
Right.
But I'm trying to make sure my dad does not lose control while he makes these smart estate planning decisions.
Yeah, you want to jump on it as soon as you can. Because once production hits, your value's going that much higher, and even if you put it into a limited partnership, 30% of 10 million, much different 30% of 5 million. So, but a few more things before I wrap up, and then we can ask individual questions. One thing to do with estate tax issues, life insurance, death benefits are tax free. So if you do have an estate issue, and let's say more money's coming in, you can buy up a big life insurance policy, get $3, $4, $5 million worth of death benefit on you. When you pass away, your heirs get that money, and then if there is an estate tax issue, they can turn around and use the death benefit to pay the estate tax and not have to worry about other tax. That's a very common strategy used. There's 1,000 different types of insurance that you can look at. For something like this, you're going to want to get into what they call a permanent insurance basis, where the insurance doesn't end based on a term or doesn't lapse because you miss payments. So there's a lot of options to look at there. We can talk to anybody about those type situations as well. That covers everything. There's a few things I want to finish up with. So any financial advisor you want to go talk to, you want to get clear on the front end. Hey, what are the fees? What are you going to charge me? What's it cost to do business? Are my investments liquid? If I need money, how long is it going to take you to send me a check? Can I get out of everything? 2, ask for a referral. Ask to talk to somebody that's done business with them, even if you don't know that person. Ask them to give you a name and number so you can call and say, hey, I'm talking to this guy. Has he been good to you? you know, you want to make sure, fees is the big thing. Make sure you know what you're paying. So I'm getting a 1 minute sign, so I think we're done. I appreciate everybody's time. If y'all have those feedback forms and want to get in touch, let me know. If you got any questions after this, I'm going to bring Peyton up here as my consultant to answer some more state questions, but I appreciate everybody's time.